Hi, I'm Scott Kubie, Senior Investment Strategist with Carson, and I want to welcome you to our first quarter market summary and second quarter market outlook, where we take a look at what happened last quarter and take a look at some of the key issues that will affect your portfolios in the coming quarter. So the first thing that marked this quarter was the fact that policymakers hit the do-over button over and over again. We saw that with the Federal Reserve and Jerome Powell. Comments that they made during the fourth quarter about raising rates and their overall lookout on the economy were just really not in line with the market expectations, and markets reacted very negatively to that. In January, and then really throughout the quarter, Powell and the Fed hit the do-over button a number of times, announcing that they would stop raising rates and even slow down and ultimately end the reduction of the Fed's balance sheet. That was very positive and viewed very positively by markets. Another group that hit the do-over button was the U.S. and Chinese trade negotiators. We had seen those groups really butting heads pretty negatively in the fourth quarter, with a lot of disagreement on how negotiations should move forward. Starting in the first quarter, we saw those groups really get together. Communication was very much in line. There were frequent meetings in Beijing and Washington. And what we generally have is a great movement towards progress. While no deal has been signed, the definite expectations, and certainly being communicated by both the U.S. and the Chinese, is that there will be a deal sometime in the second quarter. That was viewed very positively by markets. The group that hit the do-over button over and over and over again without much success was the British Parliament. They've been trying to get out of Brexit for an extended period of time and have really made very little progress. No deal seems to be popular enough to get a majority, and they continue to be stuck in trying to find ways to negotiate their way out of the European Union without doing too much economic damage. And so what we basically saw in the first quarter was a lot of policymakers hitting that do-over button over and over, with two, the Federal Reserve and the trade negotiations between the U.S. and China, being very positive for markets. That in turn allowed us to really do over or redo the negative damage that we saw from markets in the fourth quarter. The lowering of expectations for economic growth came just as the surge from the tax cut was starting to wear off, contributed to an overall global slowing. And in fact, it also caused the yield curve, which is the interest rates along various time periods, to invert. Some economists believe that when the yield curve becomes inverted, that will tend to cause a recession, because banks, which will take in deposits and pay normally a lower rate on a short-term deposit and then lend for a longer term, become less profitable when the yield curve becomes flatter, especially when it becomes inverted. And so that slows overall lending and essentially lowers the overall levels of economic growth, because credit is not as available to businesses that want to borrow. Other economists really see it a different way, as just an indication that the overall markets are expecting that the economy is going to slow at some point in the future, and that the Fed will have to lower rates in order to keep the economy going at the pace that's necessary. This is either an indication or an indicator that we have higher levels of recession risk, and it's something that we're watching very closely. We also have some issues with corporate earnings growth. Certainly the economy is slowing down, but other factors like the stronger dollar, a decrease in oil prices compared to last year, and some decrease in technology earnings are all going to push earnings growth lower. So we're not going to see the big surges that we've seen in earnings, especially last year, with not only strong earnings growth and sales growth from corporations, but also a corporate tax cut, which provided an extra boost to overall corporate growth. So there are three big things I want to leave you with as we conclude. First of all, markets have gone up a lot, but basically undid the losses that we saw in the fourth quarter. I would say markets are fairly valued, with a lot of emphasis on avoiding recession, and then continue to get at least some earnings growth over next year in order to support the valuations that we have right now. Secondly is, I think we always want to focus on risk, and we want to have a very balanced approach. There are certainly risks like Brexit, or that the trade negotiations would fall apart or stumble, and even that the economy would slow down more than some people expected. But also remember that the S&P 500 has had a huge run since the financial crisis, and there have been risks all along the way. And we always focus on taking a very balanced risk, recognizing that those risks are there, but also recognizing that they are often managed in some form, mitigated, or simply overwhelmed by some of the creativity that capitalism often brings to problems and solutions to allow the economies to continue to grow. The biggest thing that we want you to really focus on is don't catch any what we call investor amnesia. We've really seen investors switching between very positive, very negative, to very positive, and making those changes very abruptly. Stay with your long-term plan, stay focused on your goals, and don't chase and get caught up in the swings of emotion that other investors are obviously going through.